tonight's live stream. Hope you're doing well, and welcome to another event in May. I've been off for a little while, very busy May, and but I'm happy to get back on. I really enjoy doing these live streams with you, and so tonight we're going to be having an open forum. We're going to be just talking about whatever you want to ask me. I'll stay online to make sure that I can ask or answer any of the questions you might have. And then I have some material prepared, maybe just do a market update and just speak about some points. But other than that, I'll leave the floor open to you. But I'll get started just talking about a few, just sort of market update, and then I'll get into your questions. So please be sure to put your comments below in the in wherever you are, whether you're on Facebook, LinkedIn, or YouTube. Put your comments or questions in there, and I'll be able to answer your questions on the fly. We'll talk about what you want to talk about. I really wanted to do this evening because I know a lot of people have been worried about the markets and worried about what's been going on the last 5 months. Yesterday, I posted a video about, this, I think the title was, "This Market Has Me Worried." And I wanted to address, why the market is behaving the way it is, what's causing this volatility, and then what you can do about it to not only protect your portfolios, but to position them well so that they are doing well moving through and beyond this particular event. So what I'll do is I'm going to put up a couple of slides. I'll just speak to those slides, and then I'm going to leave the dance floor open to you guys to answer, to ask me any questions you like about financial planning, retirement planning, estate planning, life insurance. If you want to get into different things like RSPs, tax-free savings accounts, if you want to understand any financial planning tool or topic, lay it on me, and we're going to talk about that this evening. Okay, let's look at North American markets. You can see here that just every market actually is down. The Toronto stock market in yellow just has actually been down really from just before May. You can see there that the trend line for the Toronto stock market, if you were trying to stay away from the trouble in the markets, the best place to be was going to be in Canada. And if you look at, that's year to date, so left to right. So look at the three indices of the United States. All from the beginning of January go negative, and the Canadian market kind of danced around a neutral position, went up slightly in March, all the way through to almost the end of April, and then finally couldn't take it anymore and went negative. But it's only negative to a small degree. So if you're thinking about just one place to put your money and to be in an environment where you can protect your money, and obviously the Canadian market is much better than, if you look at the Dow Jones, is down about almost 13.5%, the S&P 500 down nearly 18%, and the NASDAQ, my goodness, is down close to 27%. So those numbers are frightening for a lot of people, rightly so. If you have money in those particular indices, you're going to be concerned about that. There you can see my mug. Maybe I'll put that over there so we can figure out how this works here. There we go. So that is an ugly part of the market, and obviously it's a big concern, right? Let me look at the next slide here, and we're going to see these are all of the equity sectors, and I'll take my picture out so you can see the actual, there we go. All the equity sectors. So when you look at the equity sectors, why I mentioned this in the last video that I posted yesterday, and I'll just check the questions. Hey, Rosemary, nice to see you. Just read your question. Okay, great question, Rosemary. I'll get to that in a second. The video that I put up yesterday, I talked about sectors, right? The allocation of your portfolio and looking at what you have in those sectors. And so many people really don't understand what they're invested in. When you look at the funds, or if you're trading stocks, then obviously you know what stock you're buying. But if you're buying a fund, sometimes the name of the fund is a little bit confusing, and it's hard for you to figure out exactly what, just by the name, it's hard to figure out what types of securities are inside of that fund. And so you actually have to get the fund information and look up the actual securities. And that's where you can go through the sectors and figure out where is this fund investing money and at what percentages, so at what weighting, so to speak. So when you look at this here, this is giving you some sectors, if you will, of where your particular fund could be invested in. So you see them going down, utilities, energy, healthcare, financial, materials, real estate. The list goes on. And you can see that really only two of the sectors are positive, energy and utilities is just barely positive. And it tends to be positive in recessionary periods, times when the market is under pressure, rising in interest rates. Utilities tend to stay positive because people have to keep the water flowing and the energy, the heating their homes and the lights on, right? So those things are a must-have. So it's important for you to consider where you might put your money. Okay, so I'm just going to see what else I've got here, and then today the announcement again in the video yesterday. I said today is going to be a bad day. We're going to get an announcement on inflation. Canada's at 6.8%. US is actually 8.4%. And that's just driving the headline news today. When you look at the news at 6 o'clock before you came on here, you would have found the market sold off in dramatic fashion today. And that's because of the fear of and the impact of inflation. Now, one thing I wanted to bring to your attention today, I don't know if I have this up here. I'll just check the other slides. There's COVID effect. We talked about that yesterday's video. That's the Federal Reserve. You can see that blue line, the Federal Reserve adding money to the U.S. economy. Essentially, that's what's inflated all of your asset prices by having all this money pushed into the market, artificially keeping the market high, and then driving interest rates lower. And when you have low interest rates and basically access to cash, you're going to find asset prices increase. So that's why your home values have gone up, and everywhere else, all your values have gone up. So all your investment accounts last year went up dramatically. When the Federal Reserve and Canada is pulling money out of the market, and I'll just go to the next slide because the next slide is Canada as well. Same thing, $1.1 trillion of debt we have. And you can see that dramatic fashion of printing money, and look at the S&P TSX overlaid there on the graph. You can see that also went up dramatically as well. So that is actually what's inflated the market. And now, because we're pulling money out of the market because of inflation, there's Canada and the United States. And I don't think we're going to get into that. So I'm going to pull this out and put my pretty face there, and we'll talk. I have one question here. Rosemary, I'm going to get to your question. You wanted to talk about whole life insurance and how to use whole life insurance as an annuity. I'm not going to say an annuity. I'm going to describe it in a different way. I'm just going to say as an income stream, okay? Annuity is kind of the same way when you think of income streams, but in this particular case, you can have a non-taxable income stream. So that might be a better way to describe that, okay? So what I wanted to sort of just explain one thing about what the Canadian government and the federal government, the US government is doing. And that is, they're raising interest rates, and raising interest rates is designed to try to have an impact on inflation, drive it down. But the two biggest things that's causing inflation, raising interest rates isn't going to affect it. So the supply chain issue that we have as a result of COVID-19 and the war in Ukraine and Russia, those two events, simply raising interest rates is not going to have any impact on that. Raising interest rates will only affect the demand for goods and services. So for instance, the real estate market. That is the effect that raising interest rates will have. Energy prices are high because of the war in Ukraine and Russia, and to a degree as well as being able to get the oil into countries because of the constraints that we've had. So that's the main reason for high inflation, and the steps that the government of Canada and the United States are taking is not going to affect that at all. So the message for you right now is expect to have high inflation for the remainder of the year, especially get used to having a higher interest rate. That means it's going to cost you more for renewals in your mortgage. If you need to borrow money, it's going to cost you more. So dramatically more. Get prepared for aggressive interest rate hikes by the Canadian government and likely the US government. So, they were talking about just kind of stepping into it. I don't think that's going to happen. I think we're going to find that both governments in Canada and the United States are aggressively going to raise interest rates because we're almost at 7% in April for inflation and about 8.5% in the United States. Okay, now Rosemary, you asked a question. I'll just remind everybody tonight is an open forum. I know I can see the people. I can't see who's online, but I know there are people who are online right now. If you have questions on any financial planning subject, feel welcome to put that in the comments in whatever platform you're using, whether it's Facebook, LinkedIn, or YouTube. I'll get that comment and I'll see if I can speak to it and talk about that. So Rosemary, if you don't mind, Rosemary, I'm gonna share your question with the group. So here's the question. David, how can you use whole life insurance as an annuity in your retirement? I'm going to say, again, I'm going to replace that with annuity. I'm going to replace that with an income stream. And I don't know if I have a slide here that might be useful to you guys. Let's see if I have a slide real quick. Bear with me, and I will share that with you in just a second, because I might actually have something that would be, rather than me just explaining it and using words, that's useful, but I think I've got a slide that can explain how that works in a better way. Yes, I do. Okay. Let me just grab that right now. How's everybody doing tonight, by the way? I haven't heard anybody how you're doing. How's everything going with work and the economy? Are you concerned about anything? Are you worried about anything? Let me know, and we'll try to address that as well. And I'm going to put this slide up right now. Here it is. Okay, Rosemary, here is your slide. I'm going to talk about, not that, my goodness, logo overlay. Here we are. So the idea around using life insurance as a tool for retirement, it's not a new concept. If you go online, you're going to see a whole lot of information about that. You're going to see things like infinite banking system. You're going to hear, you're going to see, and you have to be careful about I'll make the distinction about what you might look on YouTube, and you'll see a lot of content coming out of the United States. And in the United States, the tax laws are different from Canada, where they pay income tax on the growth of the cash value in the insurance, whereas in Canada, we don't. So it's this incredible opportunity for anybody who's using life insurance. So, okay, nice to see everybody, and everybody's online. So I'm going to get fired up here with all the questions. So what I'm going to share with you is this. It's not fair for me to say it this way, but I just like saying it because it really helps focus people on the idea of how to use life insurance. If I was to say to you, I'll give you a return in an investment stream that is right now is 5%, and it's sensitive to interest rates. So as interest rates go up, the return in this investment tends to also go up. It lags behind, but it goes up. And when interest rates are falling, the rate of return tends to lag behind and fall. So for instance, this particular strategy was yielding about 8% a year about 15 years ago, and now it's at 5% because we've had historic low interest rates. Now the reverse is happening. Now we're aggressively going to be raising interest rates. And so the return, and I have a video, check out my YouTube channel, it says is now the time to buy life insurance, whole life insurance. So you'll see cash values will begin to, insurance companies will increase their dividend. Right now, it's around 5%. Okay, so if I was to get you a rate of return of 5% a year, and that rate of return had very low risk. When I say low risk, meaning it doesn't move up and down with the stock market. It's like a turtle. It goes it's like watching paint dry, but it just produces the dividend, and none of the insurance companies have ever missed their annual dividend in like 140 years. So it's a very secure, stable type of investment. And when you receive that dividend, you don't have to pay any income tax on that. And you can leverage that, meaning you can pledge it as an asset, as collateral for a loan. So if you wanted to like qualify for a mortgage, that also becomes part of your net worth, if you will. So you can actually collateralize the cash value. And if you died suddenly, God forbid, will 10x whatever you got there. You would probably say that's too good to be true, or that's snake oil salesman kind of lingo, but that is whole life insurance. And so many people move away from that kind of idea because it's insurance, it's boring. But I got to tell you, it's one of the most savviest, simple, straightforward alternative assets that you can use to grow your money in a tax-free environment. So let's get into this. I'm going to share with you this slide, and I'm going to compare a traditional way to invest money and getting 7% on the money and using the same dollar amount, and compare that to going into life insurance, same dollar, not more or less. And the insurance actually gets a less of a rate of return, and watch what happens. And you'll tell me. So essentially, and then once you see the concept, then I'll explain how to use it. Okay. Okay. So this is on the left-hand side, a typical non-registered investment. You're going to deposit, just for the sake of this argument, you're going to deposit $1,000 a month for 20 years. That's $240,000. But as you're putting that money into the fund, you have to pay tax on that money. So that's the thing that's pulling it back, right? Your net return is not as attractive because you have to pay tax on the growth of that money. So over the course of that 20 years, and then this person in retirement says, pay me the maximum amount of money I can have over, let's say, 15 years. Think that they're a senior, for example. You don't have to wait that long, but in this example, I have to set it up properly. In this example, the person's using this to supplement the retirement, just as Rosemary is asking. So in that timeline, let's say from 65 to 85, we'll just give it 20 years, or 65 to say age 80. The person is going to, actually in this example, it was 71 to 86. So forgive me. It's age 71 to 86. So in that timeline, they're going to pull out $489,000 after tax, and they're going to use it. So imagine you've got a fund, deposit $240,000 over a period of 20 years. You pay tax when you use the money. Obviously, it's a non-registered account, and you can deplete that asset using almost $90,000. And the person dies at age 86. And you can see at the bottom on the left-hand side, there's zero money left in that account. So $0 going to their beneficiaries. Okay, flip to the right-hand side of the page. Same dollar amount. You've got $240,000 over a 20-year period, but you don't pay any income tax on the growth of the investment. So in this particular case, you're getting about 5%. It's actually slightly more than 5% right now. Dividend is the rate of return. And that money just compounds on itself. You don't have to pay any income tax. You don't report anything to Revenue Canada. It just sits there and grows. Then at the same age 71 in this example, the person will take out the maximum they can take out each year that would last them until age 86. That's $548,000, call it $550,000 just to round it up. Then the person dies at age 86. That's the same as the example on the left, but this is life insurance. So they actually give $1.3 million tax-free to their beneficiaries. So use more money using life insurance in your lifetime, not paying not a penny of income tax. And you get $1.3 million going to your beneficiaries. And the other side, use less money and you have less, $0 going to your beneficiaries. Is that making you kind of go, what did I just see? I don't get it. How come that is so powerful? How come that strategy is so, I've never heard of it, or because everybody is conditioned to use RSPs, tax-free savings accounts, right? And some of you have a lot of your money in your company defined contribution plans as well. So you never even would go close to this because it's something that you're not talking to anybody about. So I hope this is kind of giving you some kind of inspiration in terms of saying, how does that work? Okay, so what do you actually do with it? You deposit money starting at whatever age you want to do that. The younger, the better, because then you have more money growing over a longer period of time. People in their 60s and 70s do this strategy. Think of yourself if you're 60 years old and you sell your house to downsize and you've got $1 million of non-registered cash. You're going to put it into your investment and you're going to pay tax on that growth. And if you're a conservative investor, you're going to have a high fixed income component, which means it's a low rate of return and the worst possible tax of income. So it's not an attractive portfolio, and it's not an attractive rate of return. So you contrast that with taking some of that money from that portfolio and you just transfer it into life insurance every year. And then you're going to collateralize that. You're going to go to a bank and say, I've got $500,000 or whatever amount that is. And you say, I'd like to take a loan, one big loan right now for 90% of the cash value. And this only works with whole life insurance. You can't do this strategy in this way using universal life insurance. If you get somebody who says, yes, it works, it does work, but you have to sacrifice how much you can get, which is not 90%. You might get 60%. And you also have to sacrifice the growth because they're going to likely make you move your money inside of universal life insurance to GICs. They call them GIOs, doesn't matter. But it's to protect the bank, knowing that your account balance in a universal life policy goes up and down the way you invest it. Unlike the cash value in a whole life policy, when you receive a dividend, it's a hard dividend and it sits in cash. So it doesn't actually go down. It goes up because next year it gets another dividend. So it's more powerful using and more secure using whole life strategy. So you can take, I call them micro loans. You could take one tiny loan every single year if you like. You could take, you could go to, for instance, Manulife Bank will give you like an ATM card. And you could treat it like just like a checking account, and they'll basically give you a loan, and you take that card everywhere you go, and you just swipe, and you use that money inside of a loan, and it's collateralized, it's protected. You're using your own cash value to establish that loan. So you think about going on vacation, or wanting to buy a boat, or depending on how much money you have, maybe you're doing some renovations in your house or a cottage or an investment property. You can just simply go to Manulife Bank with your life insurance and get there's different programs. They're in the middle of changing the names right now, but it's basically your cash surrender value line of credit. And you can get like an ATM card and you can just start spending. So go to Home Depot, buy the wood, buy the lumber, buy the drywall, or whatever you wanted to buy, and it's just going to go against that line of credit. So it's a very interesting way to use cash values in a life insurance policy. Now, if you didn't want to spend it on fixing up your basement, you can just take it as cash and use it any way you like. And that money that comes out. Now, what's really cool about this, Rosemary, in your question, is if you're a business owner and you have money in your corporation, this is painful, right? You've got money in your corporation you want to invest. You can't have more than 10% of your cash in your corporate account. If you go over than that, then you become ineligible to use your lifetime capital gains exemption. So having a lot of cash in your corporation is a bad thing. So anything above what you need for operations is a bad thing. So what you do is you try to invest that money, but then you have to pay a passive income tax of 53% on that. Very unattractive. So what you do is you would take life insurance. So the same strategy personally, but you do it corporately. Have your company buy the insurance on you yourself. So if you're the owner and your wife, you have a spouse in the business, you just do a joint plan if you want to. But the idea is your company buys the insurance. They pay the deposit, the premiums in there. It's not income to you. so you don't treat it as like an additional income the way you would if you paid yourself a salary or an extra amount of salary because you want to put money in an RSP. You don't have to do that. And it's an asset of the corporation, so they own it, and you get to pull the money out personally, tax-free, without using any of your own money. You get to go and buy an investment property if you wanted to, and then it becomes taxed, or it could be tax deductible, the loan against the policy. So there's so many amazing ways. That's the single biggest way to pull money out of a corporation tax-free, is just to start pushing money into a whole life insurance policy that you will collateralize later and pull the money out. There is a strategy where you can actually take the money back right away. It's called immediate financial arrangements, where if you are a business and you need capital, but you also want to establish the insurance, then you simply deposit the money into the life insurance policy and then borrow it back right away and use it in your business. And now you've got the insurance eligible to get a dividend going, and you can pay back that loan anytime you like. But the idea would be, when you do pass away, the loan or the death benefit pays off the loan, and that loan would be in excess of any, the death benefit would be in excess of any loan values that you have. So there's still going to be money going to your beneficiaries. Without one more thing, I'll just say, when you do it corporately, there's a little technical, but just so you can get an idea of how powerful life insurance in a corporate environment is. Yes, you get to use that cash in the life insurance to any way you like and not pay any income tax. But when you pass away, the death benefit of the life insurance gets credited to the capital dividend account. So let's say you had a $5 million death benefit, and you used $3.5 million of cash so you actually pulled loans out and you put $3.5 million of your company's money in your pocket, tax-free. You would think, well, wait a minute, the capital dividend account would only be $3.5 million. No, it's actually the death benefit. So $5 million goes into your capital dividend account, and your capital dividend account is what is the part of the accounting mechanism that allows you to flow through assets out of your corporation on a tax-free basis. So it actually creates more room in your company so that you can flow through more assets. Now, remember, you already have taken $3.5 million of cash out tax-free, but now when you sell the business, for instance, and you have all this capital, there's a mechanism to flow through more money on a tax-free basis to your beneficiaries or charities, wherever you want that money to go. So I hope, did I get that question right? Did I answer that well enough for you, Rosemary, or did I just confuse you even more? Please let me know. And remember, guys, this is an open session, so you're welcome to put any question you want. I'm going to try to answer it on the fly as we go. And I'll just, while I'm waiting, here's another question. While I'm waiting for another question, you're welcome, Rosemary. I'll just go to this slide here and just go back to, this was yesterday's video. I talked about, how to recession-proof, or how to manage your money in an allocation that is going to be useful during this time. Financials, obviously, they make money during every economic cycle. Consumer staples, this is, your must-haves. You can't live without the companies that food, toiletries. These are all companies where you have to do those things in order to survive. You can't live without. So no matter what the economy is like, you're going to be spending money in those companies. Energy, I put a red box around it, because if things become, let's hope so, things become better in Ukraine and Russia, we should see weakness in energy prices, and that's going to begin to fall, and that will also lower inflation. But for now, energy is the only sector that is actually positive right now. Materials, these are companies that actually provide the raw materials to other companies to build things, for construction, for building buildings, steel, bridges, cars. So companies who are materials tend to do even better in rising interest rates. Their margins actually get better during this time. Real estate is obviously, if you have your own home, a good place to be would be to stay in that house. But if you have access to capital, now is a very good time for you to invest in real estate. And you kind of look at me and say, wait a minute, it costs more money for the mortgage. But any real estate investor doesn't really pay attention to the interest rates. That's not how you invest in. I mean, it's important, but that's not the factor, and it's not the one thing that you're looking for in a real estate property. So if you have access to capital right now, because interest rates are going to be a lot higher, probably closer in the United States, probably 3%. In Canada, very close to that as well. So if you have access to capital, now would be a good time to buy real estate, because what's happening, having the interest rates go up very aggressively, you're going to see it's going to push a large amount of people out of the market for buying homes and into the rental market. And that's going to drive rental prices up. And so that is actually going to be an opportunity for anybody who has access to capital to buy rental property, because the rental prices are not going to diminish. When, there's when prices come down and rates come down, everybody wants to buy a house because it's all becomes affordable. But that's not the case. We see, actually I have a slide on real estate, and let me take you to the real estate market. Anybody want to know about real estate here? I'm not a real estate broker, but I manage my clients' holistic financial planning, right? So it's not just about your money. We look at your debt, all your assets, whether you have a cottage, rental properties, your personal residence. Nearly all of my clients, when they get older, they're downsizing and selling their homes and going into a different kind of property. So real estate is very much part of the conversation when you're with me. Okay, so I'm going to share this part with you. Whoa, there we go. I'm going to lead you through just a few cities across Canada. Here's Calgary. You can see this is a 12-month graph of Calgary. Month over month is up nearly 1%. Year to date, 1.5%. A year over year increase in real estate prices of 7.5%. But truly, before 2021 January, man, they were suffering. It was a bad environment in Calgary. So it's great news to see that real estate prices are coming up. If you look near at Winnipeg, same kind of thing. Up until 2000, it really was not a great environment. Real estate prices were not going up. And we see now, this is the COVID effect, and this has been going to be a common theme right across Canada. Because of COVID, prices have gone up. So month over month, 1.9%, a year to date up 4%, and a year over year, almost 12%. So things are looking good in Winnipeg right now. You look at Vancouver, what a yo-yo ride that looks like. My goodness. So you can see 2019, 2020, 2018, kind of difficult. People saw home prices starting to crash, and now they've recovered. So you look at that window from 2000, we'll call it 2018 to 2021 is when they saw the value of their home come back. So it's not always a market that goes straight up. You can see in this particular case, Vancouver has a lot of pressure under it. So you have to be careful when you're buying real estate in Vancouver and sort of catch the wave, because it very much looks like waves here, doesn't it? But year over year, up 17%. And then we look at Toronto, look at that, 2017. We all know, if you're in the GTA, that 2018 and 19 was a difficult year for real estate. Prices came down. A lot of we'll call real estate investors had to hold on to their properties. And you can see here that the values haven't really recovered from the 2017 high. They still quite low, below the high of 2017. So I want you to think about all the condo owners. I mean, it's up 22% year over year, but it really is about timing of when you got into the market, right? No, that's not what we're going to go with. We're going to go back to me. You can see that in Toronto, when people were really fiercely going after condos and buying up as many condos as they could, and then trying to flip them, and then they got caught in 2017 where the prices started to drop, and they've just kind of remained quite low. They haven't really recovered. And so still today, people are underwater with their real estate properties, and they have to wait for those to eventually, and they eventually will come back. But that's why real estate investing, there's been so much hype about real estate investing is a great thing, but it's actually can be very difficult if you get it wrong. And in these cases, and I don't want to say get it wrong, you need to be able to carry your debt while you're investing in real estate, because sometimes the market goes the opposite direction of you. And you've got to be able to sustain that pressure on you, even though you've got some income coming in and you've got this marginal increase in your property and the equity. Still, if you're paid a couple $100,000 more for the property, it's going to take some time for it to recover. Okay, I'm going to see if I have any more questions. If there isn't, I'm going to call it an evening because I don't want to keep you longer than I have to. I can just tell you a little bit of the summary of what I've been hearing, not only from clients, but just people who I've actually been very busy with people asking me to do portfolio reviews, asking me about financial planning, specifically about financial plans and cash flow. And people are actually concerned. I've been through this many times in the sense of whenever the markets are really, really well, people don't really look at financial advisors for a lot of help, because after all, you could throw a dart at the wall and make money. But then when the markets reverse and start to get ugly, people lose their confidence about investing for themselves, and they go back to getting advice. And so that's what's been particularly busy right now, is talking to people, doing Zoom calls, telephone calls, doing portfolio reviews, just trying to help people look at their portfolios. The other thing that has been very busy for me is talking to people about their retirement plans. So many people are trying to fit all the pieces together, right? You've got a company, maybe you're a business owner, maybe you're an individual. And I've had where it's a company, people are selling their businesses, they're trying to figure out what to do with the capital, how to pay less tax on it. And they have their own personal assets. So it's kind of a complicated thing, because as a business owner, you're focused all these years on just running your business, and now you've got all this other issues to deal with. So getting the advice of a financial advisor or an accountant, somebody that can help you, give you more information, so you can make better decisions, and better decisions always lead to better outcomes. So those are the kinds of things that I've been hearing from a lot of people. Retirement planning for people who are near retirement, they're concerned about the market that we're in. And I'll just leave you with this thing here, and that is, Oren, I'll get to your question in just a second, is this kind of market isn't going to prevent someone from retiring. If you can't retire because of a negative return, and it's minus 5% in Canada, then it's probably not the best time for you to consider retirement, because that's evidence that your income stream from your portfolio isn't strong enough during a small economic shift. And that's what we're going through. So you may want to reevaluate your retirement time, or think about how you can drive more income out of your portfolio. So that's the one thing I wanted to just let everybody know. A lot of what's going on right now, it's disheartening, it's frustrating, but it's not going to spoil your retirement. As long as you're talking with somebody and you're making sure that you are clear about your goals, and you've got a financial plan, and the communication is strong, you're going to be fine. Okay, Oren, I'm just going to read your question here. Can I share this with them with the group, Oren? Would that be all right with you? Oren, I hope it's okay, because it's an interesting question. And I'm just going to put this up here. I want to know if there was something with upside, limited downside, and not lock up the money until I die. Okay, so here's a question. Is there an annuity or something like that can give me between 3 to 6%, lock up my money until I die, something that has upside and limited downside. And the follow-up to that is that you just want to make sure, I get what you're trying to say. You're saying, can I get a rate of return that is going to be positive, that I can, and I'll say this very carefully, that is fairly predictable, has a predictable nature to it, and it's going to last your lifetime? And the answer to that question is yes, there is. And there are one area that I can help you with and another area that I don't do, but you can do. So the area that I just talked about was using life insurance, whole life insurance. And so the only problem with using whole life insurance is you got to be healthy enough to use it. You have to have cash flow to pay the monthly dividend or monthly premium or annual premium. So you got to have the cash to be able to put into the life insurance. If you're sitting on a bunch of cash, then you've obviously got the money to fund it. That's going to pay a dividend of at least 5%. And I said before, interest rates are going up. So it's likely that insurance companies over the next couple of years will raise their dividend. And that dividend is about 5%. So you could get 5% on your money in a life insurance policy. I don't want to twist your brain too much with this because you might end up with a pretzel here. But what I really like about the insurance is that you deposit the money, and the cash grows. You get 5% dividend, and you borrow the money back and invest that money. Then you get to actually have the loan tax deductible. So your after-tax cost of borrowing is going to be maybe 2%. If it's 4% now, if it's 5%, your after-tax borrowing cost might be 2.5% for you to take that money out and invest in something that might produce 6, 8, or 10%. So that is a pretty wild concept, and I would encourage anybody who wants me to run illustrations for you to show you how that would work for your situation. It's easy to do, and I'd be happy to do. You just have to let me know. I have another question here. High cash value. Okay, Carl. So Carl's question is around about, I don't know if you were here, Carl, in the beginning, but I did a big thing on that. I spoke for about 15 minutes on that one. And yes, actually, I have a presentation. If you want to email me, I'll send you the exact video that talks about how to use life insurance. And it's personally and corporately, and the visual representation of that actually is really cool because I show a non-registered portfolio and pulling out the fixed income part of your portfolio and pushing that towards life insurance, whole life insurance. So it's an excellent video that I would encourage you to watch. If you just go on my LinkedIn or YouTube, you'll see in one of the descriptions of the video, there's all the ways to get in contact. There's about 5 million ways to get in contact with me. And I'll be happy to direct you to the video that talks about that. But yes, you can. I encourage anyone who has a large non-registered portfolio, and let's say your asset allocation is weighted where you've got a decent amount of fixed income, and that fixed income is going at a very low rate of return, and it's taxed at the worst possible tax rate. So it's really a disincentive to be invested in the bonds. So what you do is you take that portion and trade it off for whole life insurance. And two things happen. You start getting a predictable rate of return of 5%. You're going to instantly amplify your estate value. And then you're creating an asset that you're going to be able to leverage, right? So you get to actually pledge it as collateral, use the loan value any way you like, and allow that capital that you're using as collateral to continue to grow and get 5%. So the two are unaffected by one another. So it's really a powerful tool. So if anybody watching now want an illustration on how that might work for you, just simply email me and we'll set up a time and I'll walk you through how it would work, and you'll see the cash values. There's no cost of that. It's just us talking about how it would work. And I see that a lot right now. I've been doing a lot of life insurance illustrations, and because every time the market starts to go poorly, people look at whole life insurance. Every time, and especially 2008, people were buying life insurance like it was going out of style because they were worried about dying. They were worried about they'd just lost a third of their net worth in many cases, and they needed to make sure that if they died, the life insurance was going to at least bring them back up to a neutral position. So every time interest rates go up, my video on YouTube where I talk about is it the right time to buy life insurance, it talks specifically about that. Is it the right time? Yes, because life insurance, the growth is kind of pegged to interest rates going up. So it's a really great time to be buying whole life insurance right now. Well, I think I've covered off enough questions. Thank you so much, Oren and Carl and Rosemary, for your questions. Cardine, really great to see you on the call this evening. Ivan, we've got really awesome to see everybody. I'm glad that thank you. I'll just read you. Oren, I don't have your email. So if you want to send an email to aaronwealthmanagement@gmail.com, Aaron, AARON, wealthmanagement@gmail.com. I'd be happy to send you, and we can communicate and we'll figure that out. Okay. I don't think I got anything else for tonight. I wanted to make sure that I came on tonight to speak specifically about the markets, to answer your questions and to make sure that you feel calm about what's going on. A well-designed portfolio. Hi, Richard. A well-designed portfolio would be just fine in this environment, especially if you're heavily weighted towards Canadian versus US. And you're going to have to weather this for a little bit of time. I believe markets are going to improve. Actually, I think markets are going to improve this month. And if you're sitting on money right now, look back to 2008 and look how the markets drove down and everybody was really upset, rightly so. But look at the opportunity that you missed. Right now, markets have just gone down because of people who are afraid. And Warren Buffett is sitting on $80 billion right now, waiting for this day because he wanted to buy some companies, and they're on sale. So one of the most savviest investors in the world is buying right now, not selling. So I would just put it to you, if you've got time in front of you right now and it's within your risk tolerance and you do it in a measured way, you don't take on more obligation than you need to, now is the time to be trying to get into this market and buy the right types of investments. Well, everybody, thanks so much for tuning in today. I really appreciated that you're here. And I'm so happy to get back on the live stream. I miss being on the live stream. It's been very busy. We've actually had some difficult health things, not in my immediate family, but in my extended family. And it's been a little worrisome for us, and we're hoping that everything's going to turn out right. But I appreciate you taking the time today and joining me. And I look forward to seeing you on the next live stream. And if you're new to this whole thing, please subscribe to my YouTube channel, share this and all the other videos that you think would be useful with anybody that you think that should see this. My videos are always about education. There's nothing about selling. I make it very clear on the videos that I'm not here to brag about a certain company and say you should buy RBC or Manulife or whatever. I'm here to give you strategies, give you education about products, understanding how to use RSPs, or how for business owners, how to use your money in a better way to lower taxes and maximize the money you're using. So it's all about your education. Again, thanks so much for tuning in, and I look forward to seeing you again soon. Take care. Bye-bye.